Welcome back to Core Invest Mistake and Risk Management series. And today we are going to talk about trade psychology, beating the market.
As previous videos, we have been covering a couple of them, and all our videos are on the YouTube and also on the corehub.me. You can check us out. In this video, we're going to talk about mistakes and risk management, and specifically trade psychology.
So before we start, let us introduce ourselves. I'm Jeremy.
And I'm Wai Min. We are from Core Invest Institute.
A short disclaimer, all views and opinions are expressed in speaker's personal capacity. All contents are not recommendations, but for education and entertainment purposes. Please do your own due diligence, and past performance does not guarantee future outcome. Please do not circulate the content without the consent of the speakers.
As we have seen as well, most of us makes mistakes. In fact, everybody makes mistakes, whether you are a beginner, a new entrant, or even experienced people. A total number of mistakes, you can see that 50% of the mistakes are made by the new entrants, and a total of about 19%, the blue and the purple bar over there, represents mistakes made by people who are more than 5 years or 10 years doing trading. So mistakes are not uncommon, everybody's doing it.
So, in today's topic itself, we are going to cover all 6 of them on how we look at avoiding these following mistakes on trade psychology.
We want to point out the importance of the trading psychology. Why is it so important for us to look into the trading psychology? As we know, most of the time, whenever we want to do a trade, we will look into the fundamental analysis, we'll look into technical analysis so that we can have a proper setup, entering and exiting. But a lot of people would miss the importance of risk management and also being patient and also the emotions. So you can see that the technical analysis would probably, including the fundamental analysis, takes up about 10% of doing a good trade. But a lot of people making money, they will lose even more of it. And that is where they do not focus on risk management. Things like position sizing, trade management, and correlation management. These takes up about 30% of the success. And even larger is 60% covering patience and emotions. So things like protecting your emotional capital, waiting for the right trend, right trade, timing, avoiding revenging the trade. For example, I have lost $20,000 and I want to make back $20,000 within a month. That is a no. Those are importance of trading psychology.
So mistake number 1, being impatient. Right, this is one of the biggest emotion pitfalls of all investors. And what do we want to look out for in terms of being impatient, which is looking at the trading of your emotions, right? There are 3 levels or 3 layers of patience, right? Waiting for the trade, because you open a trade, you are waiting for it, and then you are holding on to it as well as growing your account. So let's look at the waiting for trades. When you open account, when you open your trades itself, you are waiting for it to infuse in your position. So don't break the rules, right? If you break the rules, means that you are
following the SOP already.
You're not following the SOP, right? So don't get in too early, right? And don't chase the price. So these are important because if you follow the rules, you are able to get the risk management that you are looking at, as well as the profit you are getting. So there's no you are not increasing your stress over there if you are waiting for the trades.
And very often when we try to chase for the price, we might not get the right price.
Yes.
And often we might actually be buying something which is too expensive or selling something which is too cheap.
Correct. So the next item you want to look at is holding on to trades. So when you're holding on to your trades, means your position are already filled and you are looking at the price going up. So don't cut your winners early, right? Because if you cut your winners early, right, you never know that the price will go with you and you are profiting even more. So if you cut too early, then you are missing out a lot of opportunities, right? So wait for your target profit. Where it reaches to your target profit, you can exit, or you can look at the current market condition and see if you want to set another target profit.
Especially like in the earlier video we talked about during the advancing stage. If you consult the chart, if you read the charts, you study the charts and you know that they are in a market cycle of advancing, you do not want to cut it too early. Because as what Jeremy says, you are going to reduce your opportunity. So you should not be too impatient to take profit.
Yeah, correct.
Read the chart.
And the third layer of patience is growing your account. A lot of people fall into the trap of that, I want to make money fast. How do I make money fast? And then they start to take a lot of risks. So very importantly is that money doesn't just drop from the sky, right? We need to grow that money and we need to grow it safely. So don't risk too much. If you put in a lot of capital and you start to speculate and gamble, there is a very high chance that you can even lose all your capital, right? So don't over leverage. Don't over leverage means that you borrow money to buy something more than you can afford. And that creates a lot of stress. If you want to grow your account, just do it within your means, all right? And find a way to grow it safely so that you can get consistent profit. Third is to avoid shortcuts. Normally, when people don't follow the SOP, they do shortcuts, it means that they are willing to let go some of the risk management and go into risky trades. And that is very dangerous if you want to grow your account. And last of all, if you have a long-term plan, right, that is great. Because why? You set a goal, an objective of your money, and you want to grow it consistently and safely. So these are the 3 layers of patience that you want to hold on to, right? And avoid those mistakes when you are growing your account.
Mistake number 2, mixing up fear and greed, as what our famous Warren Buffett guru says, and this is very commonly heard from him. Be fearful when others are greedy, and greedy when others are fearful. It's a great emotional pitfall for us to know.
Correct. And therefore, when we look at the market cycle, right, as we mentioned just now, there are 4 different kinds of parts in the market cycle itself. And emotions, there are also market emotions over there, a cycle of market emotions. As you can see that a lot of people, they are very happy when price or the market price is going up, they are making money. And therefore, there's a lot of excitement in the way over here, right? And this is when someone tells you about the stock, right? Most of the time, the price is already high. Why? It's because of this word called efficient market hypothesis. You can Google it, right? It means that the price has already factored in all the news, events, and trend, or rather you can say discounts all the news, right? So say for example of the company, a case study called GameStop. Again, when somebody tells you that GameStop is going sky high, it already factors all the price in, and if you were to enter at the price that they tell you, most likely it has already gone up so high that people are talking about it, right? And that is very dangerous because people feel through and they are becoming greedy, right? When they become greedy, they buy at a very high price, expecting that the price will go up. But again, when the price goes up, it can also come down. So when the price comes down itself, when the particular investor bought at very high price and the market start to contract, means that it starts to decline itself, what happens is that there's a lot of phrase of denial, fear, all coming to place that, I think the market will go up. I think it's going to be okay. But then the market price, when it comes down all the way down itself, are you able to withstand that emotion of unrealized loss? So those people who actually bought at high price and sell at low price is because they are desperate already. They could be they will be unable to control their emotions, or they may accidentally, or they may have out of greed borrowed money to invest in, and therefore they have to sell to cover, right? And that is very dangerous. And this is where it becomes a very fearful market, and then people start to be depressed, and then again buyers come in and play. Because why? Because when people are fearful, others are greedy, and they start to go up again. So this is the cycle of market emotions, and you have to be ready to accept it. One way to look at fear and greed is by looking at the FGI, the Fear Greed Index. And this space you can find on CNN, or you can find it on legendofinvesting.com as well, where this fear and greed index is there for you to understand what is the emotion driving the market now. So for this slide itself, for this example, this case scenario is that it's an extreme fear. And an extreme fear means that people are fearful. Means what? You have to be greedy as well. But please please do not say that you put all your money in there. This is just one of the indicators. Please do your due diligence as usual and look for the right opportunity and right setup, and manage your risk before thinking of entering.
Yeah, as Jeremy says, when market is going down, people are in fear, they sell. But what happens is that when it comes to a certain level of support, you might want to go in. Don't put all your eggs into one basket because it might continue to go down. That's where you want to average down, hoping that it will come up. And of course, it will come up pretty soon because you are trading at the support level. And when it comes up, when people are in fear, that's where you want to be greedy. Moving on to mistake number 3, relying on news versus noise. What is news? News coming from reputable sites like Bloomberg, like Reuters, and noise. Noise means coming from bloggers, information that is anecdotal from news and from TV. So you need to measure what is news and what is noise. Looking at the chart at the bottom there, you can see that noise in blue color is all over the place. It doesn't really give you a trend. It will cause interference to the proper signals. So things like fake news, information coming from bloggers, they will always interfere with the real news. And usually they're all manipulated by foreign agencies. And we also know sometimes very key people, prominent people, when they tweet something, it will also cause some kind of interference to the market. So you always want to read news. For me, always read only the headlines to know what is news in the market, and I read it with a pinch of salt, not really dwelling down to all the paragraphs of what it is saying. And always cross-check your facts with any other unbiased sources of news. So do differentiate what is news and what is not.
Mistake number 4, trading towards support and resistance. What does it mean? Are we looking at potential breakout or reversal? So normally when we draw our support resistance line is to identify the psychological ceiling and floor, right? Be it whether the price can go higher or the price can go lower. So if that's the case, there's one chart pattern that you may want to consider and Google about it. Is called channeling. And this channeling will share with you exactly whether the price will go up or down within the channel itself. So say for example, will you enter a trade here where the price is coming to the resistance? Will you be trading here? Or will you trade when the price is coming down and it goes below the support? Or do you want to trade here when the price is at support and starting to go up? Or will you want to trade here where the price is going up and cutting above the resistance? So if you understand the psychological behind it, you'll be able to identify whether the sellers are in control or the buyers are in control. So one good example is over here on the right side. If you can see that the opening price is at the bottom and the closing price is far above the resistance line, showing a very big potential breakout. And that is the rule of a breakout. And if you want to know more, you can always Google again to find out how a breakout of the candle can identify opportunities for you to enter. Alright, so that is looking at trading towards support and resistance.
And of course, any breakout, please make sure that you confirm the breakout, otherwise you get into a trap.
Correct.
Mistake number 5 is holding on to a losing position. So what happens when you are losing? A lot of people would want to say that, in a state of denial, remember? Denial. Or the price will come back, but then if you wait too long, you continue to lose more. So that is why it's always good practice when you do long-term stops, right? When prices are advancing, you want to do a trailing stop so that your stop will rise with the price. And when the price starts to come down, it is stopped out. And if you don't do a trailing stop, often you are in a state of denial and there's emotion trying to say that it will come back, it will come back. And in the end, you will lose more. In this example, this is BBY, Best Buy. And you can see that you have certain point of entry, right? And the price going up and you can start to put in some stop loss over there. And in this case, when the price gone beyond the second entry, very nice, price goes up. And at that point in time, you should be doing some stop losses again. That is a trailing stop. Once it breaks down that support line, you can exit. In case you did not put in that particular exit trailing stop, it goes down, you have another chance, which is a and exit at your break-even point. And if you do not do that in a losing position, you will continue to lose more. So important that you do not hold on to losing positions.
Mistake number 6, scaling up too early, right? First of all, you want to understand that if you are investing, you want to put in a small amount of money first. Why? Because the amount of money that you put in determines how much risk you can take. If you are putting in 5,000, the most you will lose is $5,000. But if you put in 100,000, that is the maximum loss that you can also lose, right? So start small. If you cannot make consistent profit over 6% or 6 months, don't scale up. If your $5,000 cannot go to $10,000, then how can your 100,000 grow, right? So follow the rule of 72%. Why do we put 60% here? Because 1 year is 72%. If you are following the rule of 72, means that in 1 year, you are able to double your money. If you can't do that, don't scale up. Because the moment you scale up, you increase your risk, you also increase your stress, and the psychological emotion will take place.
So in summary, the trading psychology, one of the most important skill to have is to make sure that you have the psychology. End of the day, we are our own, the biggest enemy. To avoid making mistakes in trading psychology, very important is be patient. Do not be impatient. Know your timing. Do not mix up fear and greed. You need to know when to go in, when to go out. Okay, when people are in greed, you want to be in fear. Rely on news which is reliable. Do not look at noise. Do not have too much interference from the noise. Trading towards support resistance, be careful about that. Having a warning sign over there. Holding on to losing positions, take the loss. Do not hold on. And do not scale up too early. Alright? And hopefully everybody is able to trade safely and smartly.
Alright, so that is the end of the series itself. If you are interested to know more about how you can trade profitably with stock and options, there are 2 QR codes over here that you can see. One goes to our website and you will be able to understand more over there. And if you are interested to look at our Facebook group to join us in our community, please go ahead and scan and we will add you over there.
So we have a couple of video series. They are all available on our website corehub.me as well as on YouTube. They are the market insights, low capital investments if you are going to keep low capital for investment, sector analysis will do that, and of course in this series, mistakes and risk management.
Invest the smart, simple way, and we'll see you on the next video.
Bye-bye.
Bye.